Elon Musk's $23.7 billion stock award, what it means for Tesla. Imagine being offered nearly $24 billion to stay at your job. That's exactly what happened to Elon Musk. Tesla's board of directors has approved a massive stock award for its CEO Elon Musk in a bold move to keep him at the helm of the electric vehicle giant. The award, valued at a staggering $23.7 billion, is one of the largest stock grants ever given to an executive. But here's where it gets controversial. This comes after a court invalidated Musk's previous $50 billion stock option package in 2024, leaving him without a formal pay structure since then. The new stock award consists of 96 million shares, which Musk can claim in 2 years, unless, of course, a court intervenes again. This move is seen as a first step to ensure Musk remains focused on Tesla, especially during a time when the company is facing significant challenges. The electric vehicle market is highly competitive, and Tesla needs its visionary leader to navigate through these turbulent waters. But let's dive deeper into the implications. Why would a company offer such an enormous sum to one person? The answer lies in Musk's pivotal role at Tesla. His leadership has been instrumental in driving the company's innovation and growth. However, this raises questions about the balance between rewarding key executives and ensuring fair compensation practices across the organization. And this is the part most people miss. Stock awards like this are not just about retaining talent, they're also about aligning the interests of the CDO. Tesla awards Elon Musk 29 billion shares, $56 billion lawsuit, stock reaction, CEO future. Elon Musk, CEO of Tesla, has been granted a whopping 96 million shares by the company's board, valued at approximately $29 billion. This interim pay package comes amid legal battles over his previous 2018 compensation plan, which was deemed improperly granted by the Delaware court. The new package will vest in 2 years, provided Musk remains CEO or holds another key executive position. However, if the legal battle ends in favor of Musk's 2018 package, valued at $56 billion when vested, the new award will be forfeited. This decision has sparked controversy, with some questioning the justification behind such a substantial payout. What are your thoughts on this matter? Is Musk's compensation warranted, or does it raise concerns about corporate governance and shareholder interests? Elon Musk's record-breaking $29 billion CEO pay package explained Tesla's future legal battle. Elon Musk has once again claimed the title of the highest-paid CEO in history, with a jaw-dropping compensation package of $29 billion. This remarkable deal with Tesla, a company valued at approximately $970 billion, comes after a Delaware judge annulled Musk's previous mega grant not once, but twice. For the past 7 years, Musk's compensation has been embroiled in legal disputes. In a letter addressed to shareholders, Tesla's board chair Robin Denholm, along with director Kathleen Wilson-Thompson, emphasized the necessity of retaining and motivating exceptional talent, starting with Musk himself. They noted, the competition for AI talent is heating up, with recent months witnessing multi-billion-dollar acquisitions and substantial cash packages for individual AI engineers who are not founders. The board members asserted that even among this elite group, no one matches Musk. Therefore, the nearly $30 billion compensation is deemed crucial for keeping Musk focused on Tesla and attracting new talent to maintain the company's edge in AI, robotics, and robot taxis. Unlike Musk's previous compensation plan, which included significant performance hurdles tied to shareholder value, the new agreement requires him to simply remain with Tesla as CEO or in a senior executive role for the next 2 years. Additionally, he must hold on to the stock until 2030, which will increase his ownership stake from about 13% to 15%. Brian Dunn, a seasoned compensation expert and director at the Institute for Compensation Studies at Cornell University, remarked that Musk's new compensation resembles what some experts call fog the mirror grants. He explained, "If you're present and can still fog a mirror, you qualify for these grants. They lack performance targets." While the award will be issued in restricted shares, Musk is required to pay $23.34 per share to acquire the stock, which is the same strike price as his options from 2018. Given that Tesla's stock is currently trading above $300 per share, this arrangement provides Musk with approximately $280 per share in built-in value, a situation some compensation experts have labeled as discounted options. Larry Cunningham, director of the University of Delaware's Weinberg Center for Corporate Governance, stated that regardless of how the award is classified for accounting or tax purposes, it can be simply described as a deep-in-the-money stock option grant awarded solely for retention. Musk's new pay package has a guaranteed floor of $26 billion. This package establishes what Eric Hoffman from Fariant Advisors describes as a floor and ceiling arrangement directly linked to the ongoing litigation in Delaware, which Tesla is currently appealing. If the courts invalidate Musk's original 2018 award of 303 million stock options again, he will retain the new 96 million shares valued at around $29 billion at the current stock price. However, if any portion of the original grant is reinstated, the new award will be adjusted downward accordingly. As Hoffman explained, there's a clause that states no double dipping. This 96 million share award could be utilized to compensate for any part of the original grant if he loses in the legal proceedings. Hoffman noted that the path the Tesla board is navigating is unprecedented in the realm of executive compensation. He stated, "There's no playbook for this. They issued the first grant, it was overturned by a judge. They created another grant, which was approved by shareholders, and then that too was held up." To provide context, a shareholder challenge regarding Musk's 2018 pay package resulted in a landmark ruling that rescinded his compensation. Subsequently, the Tesla board presented the pay plan to shareholders in 2024 for a vote, which they approved. Last December, the same judge, Delaware Court Chancellor Kathleen McCormick, declined to overturn her previous decision, which Tesla has since appealed. In their communication to investors, the board acknowledged the uncertainty surrounding the court's timeline and characterized this award as a first step, a good faith payment to Elon. However, Tesla's performance in 2025 starkly contrasts with that of 2018, when Musk was first awarded his ambitious moonshot grant. Following that award, he managed to increase Tesla's value 12-fold, with its market capitalization exceeding $1 trillion in October 2021 and again in May 2025. Yet, Tesla has faced challenges recently, with its share price declining over 18% year-to-date. Musk's political activities, including his support for President Donald Trump, have also alienated some of Tesla's environmentally conscious consumer base, particularly in California. This time, the board has taken significant steps to mitigate risks. In May, they established a substantial legal barrier that complicates any challenges to this award. Following McCormick's ruling, Tesla shareholders approved a transition from being incorporated in Delaware to Texas. In May, Texas revised its business code and Tesla promptly updated its bylaws. This amendment introduced a new requirement that any shareholder wishing to contest Musk's pay in court must hold at least 3% of Tesla's stock, a stake valued at over $3 billion. John Coffey, a law professor at Columbia University, explained, "The central theme here is that Tesla has shifted its jurisdiction of incorporation from Delaware to Texas, meaning that the appropriateness of Tesla's actions and Musk's compensation will now be evaluated under Texas law, which is generally more lenient. Tesla may face lawsuits, but the odds are more favorable for them in Texas. Texas has actively promoted itself as a business-friendly state following Tesla's relocation. It remains uncertain how Texas courts would handle any legal challenges." Cunningham remarked, "It will be intriguing to see if a Texas court opts to follow Delaware's analytical framework or chooses to avoid similar judicial scrutiny. The outcome could significantly impact how other companies assess the advantages of Delaware versus Texas as their corporate domicile." Investor reactions to Musk's compensation have been mixed. Tesla boasts a dedicated base of retail investors, many of whom support Musk and have voted in favor of his compensation plan on 2 occasions, securing majority approval. However, some pension fund leaders managing retiree assets invested in Tesla stock have expressed their discontent with Musk's new compensation package. New York City Comptroller Brad Lander stated, "A $29 billion compensation package for any CEO, especially one who has been largely absent from daily operations while sales and stock values fall short of investor expectations, is outrageous." Lander accused Tesla's board of enriching Musk at the expense of investors once again. Illinois State Treasurer Michael Frerichs described the $29 billion compensation package as egregious on its face. He added, "Given Elon Musk's lack of attention to Tesla's daily operations and the company's disappointing stock performance, this package indicates a board that is out of touch with its responsibilities to investors." With revenues not meeting expectations, the board should prioritize long-term planning for the company's success over catering to a greedy CEO. Shareholders deserve better corporate governance. The SOC Investment Group, representing a coalition of investors holding nearly 8 million shares in Tesla, issued a statement highlighting a notable admission from the board. They remarked, "Even an additional $24 billion in equity might not be enough to persuade Elon Musk to remain for another 2 years, let alone ensure he dedicates sufficient time and effort to reverse the current decline in sales."